Marvell Technology Inc., trading on NASDAQ under the ticker MRVL, is currently at $93.65, reflecting an intraday move of plus $0.75, or a gain of about 0.81% as of late morning trading on November 6, 2025. Now, the common expectation for Marvell is that it's a solid semiconductor play, riding the coattails of the broader data center and artificial intelligence infrastructure boom, a narrative we see so clearly driving the valuations of companies like NVIDIA stock. Yet the reality today introduces a more intriguing, almost immediate tension. The stock is climbing, yes, but it's doing so with the persistent rumor of a potential acquisition by SoftBank that circulated recently, a rumor that was reportedly abandoned over valuation, but clearly injected a speculative premium that the market hasn't fully digested. The initial pop on that news showed just how undervalued some players believe Marvell's core technology is, especially its custom silicon and data infrastructure solutions, which forces us to look past the routine sector momentum and assess the true intrinsic value being chased by large patient capital. This is the unexpected angle, not just organic growth, but the market's whispered price for a buyout, which sets a much higher floor than typical earnings multiples might suggest. The general belief among investors looking at the semiconductor space is that if you're not NVIDIA, you're a secondary player, a provider of components rather than a system-level architect. Marvell, for all its technical prowess, has historically played a supporting, though critical role in the data center, carrier, and enterprise networking environments. The stock's performance this year has been excellent, swinging from a 52-week low, near $47, to the current levels. But it has recently experienced significant volatility, partially fueled by that takeover chatter. More recently, in the lead-up to this week, the stock was attempting to establish a new consolidation base, trading within a relatively tight range between the low $90 and high $90. Today's action, an uptick on solid but not excessive volume of over 14 million shares, suggests a continuation of that consolidation, albeit on the high side, indicating underlying technical strength and persistent institutional accumulation. Looking at the technical picture, the stock is holding above its 20- and 50-day moving averages, which is a very positive sign for short-term momentum traders. However, that high of $98.13 it hit earlier in the session, nearly pushing into triple-digit territory, shows the constant battle between profit takers who see the recent SoftBank-induced spike as a selling opportunity and new buyers betting on its long-term data center thesis. This resistance point becomes a crucial psychological and technical level for the short-term trajectory of the stock, where heavy selling pressure can often negate strong fundamental news if the volume dries up. The deep analysis reveals that Marvell's real story isn't just about general chip demand, but a specific, highly strategic shift towards custom silicon for hyperscale data centers, the same critical infrastructure that supports cloud services and increasingly the intense computational demands of AI. Their portfolio, which includes Ethernet solutions, interconnect products like PAM and coherent DSPs, and custom ASICs, positions them as a key enabler. They are, essentially, building the internal plumbing for the biggest technology companies in the world. Their recent earnings reports have strongly reinforced this, with impressive year-over-year revenue and EPS growth, particularly driven by their data center segment, which saw a major spike in the last reported quarter. This is the reality that challenges the expectation of a secondary player. In the world of high-speed connectivity and bespoke processing power, Marvell is becoming indispensable. When you look at the growth rates, EPS increasing by over 120% and sales up nearly 60% year-over-year in the latest quarter, you can see why a large fund manager, perhaps a customer of Fidelity or a client of Interactive Brokers, would be so interested in this underlying organic story, separate from any speculative M&A noise. These figures are what truly justify the technical breakout setups being monitored by professional traders. The fundamental acceleration suggests that the company is taking market share, and its product cycle timing is hitting perfectly with the massive capital expenditure cycles of cloud providers, which provides a level of clarity and confidence that many competitors in the sector lack. It highlights the success of their disciplined strategic spending, which is a key consideration for anyone considering online investing, comparing the fundamentals against the noise. On the institutional side, the activity is mixed but telling. We saw significant increases in positions by some large firms in the last reporting period, even as others trimmed their holdings. The fact that the total value of institutional holdings is so high, well over $60 billion in recent data, confirms that this is not a retail stock driven by fleeting social media hype, the kind of phenomenon you might associate with some of the wilder Robinhood stock trading segments. Instead, it's a core holding for serious institutional money, which often means an extended time horizon for their investment. This high institutional ownership provides a significant stabilizing force, meaning that while the stock might be volatile daily, there's a strong, long-term belief in the business model that prevents massive sustained sell-offs. For individuals who practice self-investing, the movement of institutional capital is a key indicator to watch, as it often separates high-quality growth companies from speculative bets. When we consider how the major custodians like Fidelity and their mutual funds and ETFs allocate capital, Marvell's focus on high-margin, specialized data center components makes it a natural fit for technology-focused funds, much like how Schwab Intelligent Portfolios might allocate capital into sector-specific ETFs. The institutional activity, in this case, strongly validates the deeper thesis that Marvell is a critical component of the future data infrastructure. To understand the full context of Marvell, a brief look at their structure is important. Marvell is a fabless semiconductor company, meaning they design the chips but outsource the manufacturing, a capital-efficient model. Their core segments, data center, enterprise networking, carrier infrastructure, and automotive and industrial, all benefit from the increasing need for higher bandwidth and faster processing power. The data center segment is the clear growth motor right now, fueled by the accelerating adoption of AI. Their competitors include giants like NVIDIA stock in some areas and specialized firms in others. But Marvell has carved out a distinct competitive advantage in the complex optical interconnects and custom ASICs needed to wire up the enormous clusters of GPUs powering modern AI models. This is where the money is being spent today, not just on the AI processors themselves, but on the infrastructure that make them work together efficiently. Their older reports, while showing lower revenues in prior years from transitioning away from lower-margin businesses, illustrate a deliberate, strategic pivot towards these higher-value, higher-growth markets that is now clearly paying off. This transition is what makes the stock so compelling now compared to its past performance, as the market is clearly rewarding a focused, high-margin business model over a diversified, lower-margin one. The strategic shift is not merely a change of focus, but a fundamental re-engineering of the entire business model to capture the most profitable segments of the digital infrastructure spending cycle. As we shift to the future outlook, the expectation versus reality dynamic becomes central. The expectation is that Marvell will simply continue to grow with the data center trend, an easy narrative to accept. The reality, however, is more nuanced and exciting. The key catalyst is not just general growth, but the maturation of their custom ASIC pipeline. Designing a custom chip for a major hyperscaler or a specialized AI company is a multi-year project, and the revenue from those wins is just starting to flow. The long-term reality is that these custom silicon deals lock in high-margin revenue for years and make the customer incredibly sticky, effectively establishing a captive market. This creates a powerful financial moat that goes far beyond a typical product cycle, fundamentally increasing the company's enterprise value, which of course is what SoftBank was likely interested in to begin with. This is the core of the investment help you should be seeking, understanding the long-term structural revenue drivers. One significant opportunity lies in the burgeoning field of co-packaged optics and linear pluggable optics, technologies Marvell is heavily invested in. These are next-generation solutions aimed at drastically reducing power consumption and latency in data centers. As data demands and AI compute power keep climbing, current electrical signaling methods will hit a physical wall. Marvell's early leadership in this specific high-tech subsegment of connectivity hardware means they're poised to become the standard for the next generation of data center build-outs. This is a powerful yet underappreciated factor that suggests the market may still be underpricing their future revenue potential, given that data traffic is only going to intensify with the global proliferation of streaming and data services. This kind of specialized technological leadership is exactly what we look for when we examine high-conviction growth stocks. It's the kind of complex analysis that can elevate the performance of a self-investing portfolio using platforms that offer advanced research, not just basic trading.